Welcome back to Intelligent Investment Today, the podcast concerned with all things value investing. In each episode, we take a different topic from the investment landscape and try to apply the lessons as laid down by the man widely regarded as the founding father of the craft, the tutor and mentor to Warren Buffett, no less. We're of course talking about the late, great Benjamin Graham. In this episode, we're going to tackle a situation that every value investor has felt at some point. Watching your carefully chosen investments underperform for months, even years. It can be frustrating, it can be psychologically challenging, and it's precisely the kind of environment that Graham's teachings were designed to navigate. So we're going to be asking a very simple question. What happens when your value investing feels broken? When your undervalued stocks keep going down, and the market seems to reward speculation instead of patience? Graham repeatedly warned investors against confusing price with value, speculation with investment, and activity with intelligence. In this episode, we'll confront that tension head-on, through the use of real-world examples and historical case studies of investors who stuck with value investing, even when it seemed like it wasn't working. So, as ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Value investing, at its core, is simple enough in concept. Buy securities that trade below intrinsic value, wait patiently, and watch the market correct itself over time. But simple in concept is very different from easy in practice. Stocks that seem cheap can stay cheap, and they can get cheaper still. Market noise, investor sentiment, and economic disruptions can all conspire to mask underlying value for months or even years. Benjamin Graham wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." And this is the paradox that every value investor must confront. The market may ignore fundamentals for long stretches, testing patience and psychological resilience along the way. And in those stretches, investing can feel broken. Just think about it. You identify a company whose earnings, assets, and other underlying fundamentals strongly suggest it is undervalued. You buy its shares at a discount, and then nothing happens. Or worse, the stock declines further still. And many investors panic at this stage, and they may sell out. They switch strategies. They abandon the principles that initially led them to quality opportunities. Yet for those who endure, those periods are not failures. They are opportunities. They are tests designed to separate the transient from the truly disciplined. Let's begin with a famous enough example. Warren Buffett's early investment in GEICO. Back in the 1950s and 60s, Buffett was building his investment philosophy under the guidance of Benjamin Graham. He studied balance sheets, cash flows, and intrinsic value, like a detective examining evidence in a murder case. GEICO, a relatively small insurance company at the time, caught his attention. The business was profitable, well managed, and priced below its intrinsic value. And the potential seemed obvious enough to Buffett. But here's the catch. The stock didn't soar immediately. In fact, it wavered. And in the eyes of impatient investors, it underperformed. The market was sceptical. GEICO faced temporary setbacks in policy growth. It faced regulatory challenges and broader market volatility. Many would have sold out at a loss, chalking it up to poor judgment. But Buffett did not. Guided by Graham's principles, margin of safety and intrinsic value, he held firm. And over the following decades, GEICO grew into a cornerstone of Berkshire Hathaway's success. The lesson here is simple enough. Short-term volatility is not the enemy. Impatience is. Value investing may sometimes feel broken, but the underlying business doesn't care what the market thinks about it today. Next, let's turn to Benjamin Graham himself. In the 1930s, during the depths of the Great Depression, Graham managed the Graham-Newman Partnership. He sought out stocks trading far below intrinsic value. Industrials, utilities and overlooked sectors with strong balance sheets and earnings potential. Yet, even these carefully selected companies underperformed for extended periods. Some didn't show meaningful gains for years. Stock prices stagnated, and occasionally they declined further. Graham considered these periods to be natural. The market, driven by sentiment and speculation, doesn't always price assets rationally in the short term, and only patience allows the weighing machine to finally assert itself. One example, an industrial company purchased in the early 1930s, appeared undervalued on paper, yet its stock drifted sideways for 5 years before the market finally recognised its true worth. Investors who abandoned ship early missed out on substantial gains. Graham's philosophy was clear. Investment is a marathon, not a sprint. Understanding the underlying value of a business allows investors to endure periods of market neglect and eventually to profit from them. Modern investors have experienced similar frustrations. After the 2008 financial crisis, value investing seemed irrelevant. Growth stocks, particularly the tech giants, dominated returns. Traditional value sectors, banks, energy, industrials, lagged for years. Imagine an investor in 2010, holding carefully chosen undervalued stocks, while the broader market celebrated the meteoric rise of tech unicorns. Each quarterly report showing underperformance would tempt them into abandoning discipline and chase those short-term returns. Yet history has consistently shown that patience eventually pays off. By 2020 and 2021, many of these undervalued sectors rebounded sharply. Energy and financial stocks surged as earnings growth returned and market irrationality corrected. The lesson is timeless. Value investing may feel invisible in the short term, sometimes uncomfortable in the medium term, but ultimately proves effective when the market finally recognises the true worth of the underlying business. As Graham would surely remind us, the market may take its time to reward rational analysis, but eventually value will emerge, often with significant returns for those willing to endure the wait. So why does value investing feel broken so often? That can be put down to short-term market noise. Daily price swings, headlines, and social media chatter can mask the fundamentals. Behavioural biases too, fear, greed, and herd mentality often mislead even disciplined investors. Macro disruptions like recessions, geopolitical crises, and pandemics can suppress strong companies' stock prices temporarily. Long periods of underperformance, when the growth stocks dominate, value portfolios can lag, sometimes for years. The point is clear. These periods are tests, not failures. They measure discipline, patience, and adherence to principle. The very inefficiencies that frustrate investors are the very same ones that reward those who stick to the strategy. So what can modern investors take away from these case studies? They teach us to stick to the process. Rely on intrinsic value, not short-term price signals. Embrace patience. Returns may take many years to materialise, but time is an ally to the disciplined investor. Stick to focusing on the fundamentals. Cash flow, earnings, and asset value far outweigh short-term market movements. And prepare psychologically. The ability to endure underperformance separates successful investors from the rest. Patience isn't an optional virtue in value investing. It's absolutely essential. The inefficiencies that frustrate the great body of investors are the very opportunities that generate substantial returns for the disciplined few. Consider these timeless reminders. Firstly, from Warren Buffett. He said, "The stock market is designed to transfer money from the active to the patient." And Benjamin Graham, who added, "The essence of investment management is the management of risks, not the management of returns." From Graham's era to Buffett's early career to the post-2008 market, one truth stands out. Value investing may feel uncomfortable and psychologically challenging in the short term, but for those who adhere to its principles, the rewards can be substantial and enduring. And on that note, we draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed it and that these case studies have reinforced a timeless lesson at the very heart of value investing. That intelligence in investing isn't measured by immediate returns or excitement, but by discipline, understanding and patience. If you found this episode worthwhile, do consider subscribing or adding it to your playlist. That way you'll be reminded whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.